Look at these two charts. Gold is pushing to new highs. Bitcoin isn't. And that shouldn't happen. Same system, same macro environment, completely different behavior. And if you watched the last video, where we broke down how Bitcoin moves with liquidity, this should feel uncomfortable. Because if Bitcoin is tied to global money conditions, and gold is supposed to protect against instability in that same system, why are they suddenly telling two different stories? If they're both hedges, shouldn't they be moving together? That's the assumption. But markets don't diverge like this when everything is stable. When two assets designed to solve the same problem stop behaving the same way. That's usually when something deeper is shifting. Let's start simple. Gold has been grinding higher. Quietly, steadily, almost boring. Bitcoin has been volatile. Sharp rallies, sharp drops, and lately, hesitation. So either one of them isn't acting like a hedge, or they're reacting to completely different forces. Most people assume the answer is inflation. Inflation up? Gold up? Inflation up? Bitcoin up? Simple, logical. Wrong. Because history doesn't cooperate. In 2021, inflation surged at the fastest pace in decades. Gold didn't explode. Bitcoin didn't behave like a stable hedge either. So inflation alone can't explain this. And no, this isn't another "the dollar is collapsing tomorrow" story. Something else is happening. And if you remember from the first video, Bitcoin trades on liquidity. When money floods the system, it rises. When liquidity tightens, it struggles. So the real question becomes, if liquidity is tight, why is gold still rising? And the answer isn't inflation. It's who's buying. Because when you zoom out, one pattern becomes impossible to ignore. This isn't retail piling in. This isn't social media hype. It's central banks. For the third straight year, central banks around the world have bought over 1,000 tons of gold annually. Not hundreds. Thousands. That's not momentum chasing. That's not speculation. That's positioning. And central banks don't position for next quarter. They position for trust. They buy gold the way you buy insurance. Now compare that to Bitcoin. Bitcoin trades on exchanges. It reacts to ETF flows. It moves with risk appetite. It responds to liquidity cycles. Gold is being accumulated. Bitcoin is being traded. That difference matters. Because when liquidity tightens, like we discussed in the Bitcoin video, high beta assets feel pressure. Money becomes expensive. Risk appetite cools. Volatility increases. Bitcoin reacts almost immediately. But gold isn't reacting to liquidity. Gold is reacting to confidence. Specifically, confidence in the monetary system. Bitcoin reacts to liquidity. Gold reacts to confidence. Those are not the same signal. And right now, central banks are slowly diversifying their reserves, not dumping the dollar overnight, not triggering panic. Just reallocating, quietly. It's the financial equivalent of someone updating their backup plan. You don't do it because everything is fine. You do it because you're not fully comfortable. That's a very different type of buying pressure than speculative ETF flows. So, while Bitcoin reacts to the cost of money, gold reacts to trust in money. Related? Yes. The same signal? Not even close. Now zoom out even further. Stocks are near highs. AI companies are priced for aggressive growth. Risk assets don't look like they're in panic mode. Yet gold is acting defensive. And Bitcoin? It's caught in the middle, too tied to liquidity to behave like gold, too volatile to behave like a traditional hedge. It's almost like each asset class is pricing a different future. Stocks are pricing optimism. Gold is pricing caution. Bitcoin is pricing liquidity. 3 assets, 3 different stories. That's not alignment. That's tension. Historically, markets tend to pick a lane. Either risk surges and defensive assets fade, or fear rises and defensive assets lead. But when gold is strong while stocks are elevated and Bitcoin is unstable, it suggests something subtle. uncertainty without visible crisis, positioning without headlines, hedging without panic. And that's what makes this divergence interesting, because this isn't about which asset is better. It's about what they're reacting to. Bitcoin amplifies liquidity cycles. Gold reflects trust shifts. And when liquidity and trust start moving in different directions, that's when the system gets complicated. In the first video, we asked, what is happening to liquidity? Now we're asking something slightly different. What is happening to confidence? But here's the bigger tension. If liquidity explains Bitcoin, and trust explains gold, then what explains stocks still sitting near all-time highs? Because stocks are supposed to reflect growth, future earnings, economic strength. So why do they look optimistic, while gold looks cautious and Bitcoin looks unstable? Because when markets disagree like this, they usually don't disagree forever. Eventually, one narrative wins. And when it does, everything tends to move together again.